Coming up today, stock indices trade mixed. Nvidia hits a brand new all-time high. What's next for the AI bull market? Tesla earnings on deck this week. Silver continues to push higher. A look at an AI and cyber stock Stanley is invested in. And while we could still be at the beginning of a fourth industrial revolution, we're only getting started around here, guys. Let's go. And so even though the stock indices traded a little mixed today, S&P 500 just down a touch, NASDAQ Qs up a touch a little bit, we've actually still got the VIX decreasing. Volatility is coming out of this market. And as we move into the last week of October, we don't seem to have gotten that October seasonality that we heard so much about at the start of this month. And like I alluded to back then, what was if the market just kept on grinding higher into the election? So why isn't this October seasonality playing out? Election year, coming into Q4 hot? Well, I think it's a few things. We've got what I think possibly the most supportive and loose monetary and fiscal conditions we've ever seen. Fed just cut 50 basis points. Government spending off the charts, really trying to keep markets propped up here. So the market was already on a firm footing, trading really strong. Now we're getting strong market pricing that we're likely to see a Republican win when Americans finish casting their vote 2 weeks from today. And so the market's interpreting that as we're going to get a more pro-business administration, looser regulations, and the good times could keep rolling. We've seen big moves in tandem with that huge lead of the Republican nominee and the potential boom in US manufacturing, reshoring of production. We can see that in US industrial stocks. Bitcoin's moved higher as of late, and other ETFs like the American Industrial Renaissance ETF, which is also sitting at all-time highs. So what happens if the overwhelming narrative out there, online at least, is wrong? What happens if we're just past the halfway mark of a 25-year secular bull market? What happens if AI is the most deflationary thing we've ever seen in our lifetime, helping society and businesses to gain leaps and bounds in productivity, efficiencies, helping to bring down the prices of goods while they can still expand their earnings per share? It's got Nvidia breaking out on a really strong candle here today to all-time highs, just as I'd been thinking the last couple of weeks. And this happened in a pretty soft tape today. This is a really good sign of what's set to become the biggest stock in the market again. Now just a stone's throw away from Apple's market cap and currently over $3.5 trillion for the first time. So we very well could be in the roaring 20s, which is a contrarian view and upsets a lot of people when I say stuff like this. Already got earnings per share at all-time highs, corporate buybacks all-time highs, GDP expectations expanding, market-wide participation, key sectors other than tech breaking out. I mean, what's not to like? And if this is the roaring 20s, how do you want to look back on it? As a time of being filled with fear, as being kept out of the market by your favorite furu, or as a time of excitement and growth? For example, if you could go back to 1995, would you buy internet stocks, or would you hold your breath with suspense, waiting for the top, practically impossible time? So in my opinion, there's lots of great things happening out there. And here on Click Capital, we're the most bullish channel focused on finding those opportunities and identifying the strongest markets out there. Because the biggest argument we hear from the bears is that things have gone on for too long, for too far. The market cap to GDP is 200%. It's never been above that before in history. That means it can't go above that. The Schiller PE, all these things, as most people are overly obsessed with just looking at metrics on the S&P 500 index, which, keep in mind, is just one index concentrated on a handful of stocks. And so I think a lot of these bears suffer from what's known as gambler's fallacy. That is, if something's happened many times in a row, the odds increase of the opposite. You see this quite a lot in the casino. For example, on the roulette wheel, we start getting a string of blacks in a row, people start betting on red as they think it's more likely, when in reality, it's more likely we get continuation. For example, the dealer may be spinning a ball in a certain way that causes it to land on a certain color or numbers, as a simple example. And so I think a lot of investors get caught up in this. Stocks have been going up for so long now, they think they've got to come back. Surely we can't keep going higher. But the reality is, once a bull market makes it to 2 years old, like this one just did, quite often it keeps on going, and it can keep on going for many more years further. I think the S&P 500 is going to have another good year next year, and I think the risks are to the upside, actually, with inflation, which means you still want to be in stocks, just the right stocks. Anybody who's completely out of the market, they are long cash and short inflation. In my opinion, one of the worst positions to be in. Because when you're long cash, when you're long, for example, the US dollar, this is the chart that you're long. US dollar's lost over 95% of its purchasing power over the past 100 years. And so when you're long cash, if inflation keeps going up, your purchasing power goes down. And so being short inflation at a time of record government spending, record amount of currency in circulation, that is a very tough trade in my opinion, for those trying to time the top of this bull market. And we're just constantly getting more and more bullish technical sign. We're just in the midst of a 6-week win streak in the S&P 500, which tend to happen in bull markets. Looking back in history, 86% of the time we're higher a year later. And another one for you, S&P's posted 10 gains in the last 11 months. Looking back in history over the last 100 years, 12 out of 13 times, the business cycle did not peak in the next 12 months. The only last time that happened was 1929. And we're continuing to get more and more signs that we're still in the earlier part of the business economic cycle. cycle. Corporate earnings are expanding along with their expectations, and what a new government could do for America is really fire up the manufacturing sector that's been lagging for decades, as a lot of those jobs and industries were shipped overseas. Now there's a strong political will to reshore manufacturing back in the States. The age of infrastructure and fixed assets in America is old. A lot of stuff needs fixing. Trillions of dollars spent overseas that should have been spent domestically to repair bridges, airports, roads, lower the cost of health services. The list goes on. Plenty of companies now talking about reshoring as well, and this is coming off the back of years and years of underinvestment in US manufacturing. And so this could be another driver to help this secular bull market propel higher. And whilst it's still early days, companies mentioning weak demand is coming down, as we're seeing a little slight uptick in manufacturing PMIs. Potentially some green shoots in US manufacturing. But all that doesn't really matter. I could sit here all day showing these stats, making a bullish case. A lot of bears will point to one isolated indicator, valuation of the S&P 500 index, call me a perma bull, etc., etc. However, I'd rather be a perma bull than perma wrong. And it just reminds me of the famous quote by one of the best fund managers of all time, Peter Lynch. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Something I've seen a lot over my 20 plus years of trading and investing. However, I'd say the guy who has the best quotes of all time, famous philosopher Mark Twain, worrying is like paying a debt you don't owe. So like I said, imagine going back to the mid 1990s and just spending that entire decade worried about valuations, worried about the top. And of course it eventually got there. However, there was a lot of money made leading up to that point. And the fact is, there's nothing more bullish than a stock hitting brand new all-time highs. No overhead resistance, it's blue skies, and I wouldn't be surprised if Nvidia hits 5 trillion, who knows, maybe even 7-8 trillion before we get that big scary 30 to 40% bear market and correction. And I think others will catch up as well, like AMD, making good progress, and GPUs to compete with Nvidia. Valuations aren't too bad either, and the stock has been lagging a lot. In fact, it's well off its highs from early March this year. Also been lagging a little bit of late Microsoft. Some people doubting Copilot technology. We're now getting news that Microsoft will roll out a new autonomous AI agents next month, trying to compete with Salesforce, another big company in business productivity and enterprise tools. But don't be fooled, this is a growth-led bull market. Here's a look at the top performers this year. Even got Carvana up there, Sweet Green Restaurant, there's Nvidia, Palantir, Hims and Hers Health, Robinhood, Arm, TSM, Rocket Lab. Got a lot of good secular trends happening out here. Not just AI, robotics, Internet of Things, quantum computing, digital platforms, fintech, space, nuclear, you name it. A lot of exciting stuff happening. And just looking at the PEG ratio for next year, that's the price to earnings to growth ratio. You take the PE, divide it by their expected growth and earnings next year. So a PE at 40, expected to grow at 20%, give you a PEG of 2. There's Apple well out in front. Market really pricing in. The new iPhone 16 is going to get Apple back to growth. It hasn't really been growing these last couple of years. However, you look at some others, like TSM, Taiwan Semi, I think could be one of the biggest companies in the world in the coming years. They're diversifying out from Taiwan, building manufacturing plants in Japan, Arizona, and like I said, AMD, one of the best valued stocks in the whole AI chip trade at the moment. And this AI boom is spilling over into other sectors like we've seen of late. Nuclear energy, uranium, one of the hottest stocks right now out in the market, which is still continuing to rip even today. There's Lightbridge that I reported on Friday, ripping up another 25% today. NuScale Power, one I've got my eye on. They're into small modular reactors, still trading firm, along with other similar ones. Nano Nuclear Energy, slapping on another 34% today on heavy volume. And Oklo, involved fission reactors, backed by Sam Altman, the guy behind ChatGPT, continuing to rip here today, up 22% on heavy volume. Like I said, the wheels are in motion. And so the fact is, America's doing better than what the media, politicians, plenty of people online are trying to convince you of. Just dominating the technology of today and tomorrow, making leaps and bounds, and everything from AI, quantum computing, hydroponic farming. That's why I believe we're still in the early part of the fourth industrial revolution. You could think of the first one as a steam-powered engine, railroads, which opened up enormous amounts of industry, allowed for transport of goods and people all across the country. Then you could think of the second industrial revolution, creation of electricity, mass production, Henry Ford, real kind of start of consumerism. The third being the digital information, the internet, computers. And I believe the fourth industrial revolution, artificial intelligence. Like I said, it's going to unlock massive amounts of productivity and efficiency gains. Businesses being able to replace human workers with robots, and like most technologies, can significantly bring down the price of goods and services. At the same time, companies can squeeze their EPS higher. And so the US economy and market is likely to dominate for many more years to come. And according to UBS, they think there'll be a no landing, and that could drive the S&P 500 to a 13% gain next year. They say inflation will remain low and leave room for the Fed to cut. And this is why the stock market's already getting excited. Economy and corporate earnings already expanding expanding, inflation coming down, not just in the States, but around the world, allowing for a global easing cycle, kind of like a Goldilocks setup. And this is on top of all the new amazing technologies that are helping to drive businesses higher at the moment as well. And so, like I said, while there's a lot of rhetoric out there, like, oh, the election, it's October, what's going to happen? Maybe the stock market's actually getting excited by the election and the prospects of a new, more pro-business government. And this 15-year secular bull market may be just past the halfway mark. On deck this week is Tesla, reporting earnings after close on Wednesday. I expect them to beat on expectations. Market's given a pretty muted response to the unveiling of their Robotaxi and Optimus bots. So far, I think the market's underappreciating their potential to not only continue dominating in electric vehicles, battery storage, but also Robotaxis and the Optimus bot. These are big, long secular trends that Tesla could potentially be the #1 brand leader on for many more decades to come. And so even though I think Tesla is likely to beat on expectations and we could get a gap up above 240 and who knows, start running towards 250 or higher, in a way I'm kind of hoping for it to gap down so I can add more shares to my long-term position in the stock. And it's funny because the other day I got called a Tesla fanboy, an Elon Musk fanboy, to which I said, I am a Tesla and Elon fan. This whole Tesla fanboy expression is pretty lame if you ask me. Just another coping mechanism for the bears who are on the wrong side of history and who will one day regret being on the wrong side of history as well. But anyway, just looking at the stock price, we're definitely coiling up here, going into earnings. Could be gearing for a big move, either up or down. So we'll be covering this one come Wednesday night. And there's a look at some earnings we're just getting coming in after close today. A little bit mixed up the top, not really big companies to start the week off just yet. Tomorrow we've got General Electric, Verizon, TXN, a few others in there, with the real standout this week, Tesla. Expected to report 60 cents in earnings per share. Also got Coke, T-Mobile, IBM, ServiceNow could be another big beneficiary of the AI boom. Looking out Thursday, S&P Global, Union Pacific, and Friday is always a quiet day for earnings. It'll be really next week we really start to gear up into big tech, all other big blue chip stocks as well. Microsoft Meta next Wednesday. Expect them to come in with good beats as well. So still early days in Q3 earnings season. Had 72 S&P 500 companies report. 74% of them beat expectations. 60% beat on sales. So far so good. Holding up pretty good. Moving on to China. They're continuing to roll out stimulus measures one by one, cutting their benchmark lending rate by 25 basis points. This Monday, as they continue to intensify their efforts to get underneath their de-accelerating economy and especially their capital markets. And I'd say a big part of this is because they too are forecasting a Republican win. They're worried about what tariffs could potentially do to them, knock them over even further. And so I'd say they're looking to get a head start on that and start pumping things up before they potentially get slapped with some new tariffs, which I think are going to be used as a negotiating and bargaining chip as they can get pulled away if the states get something in return that they want. And there's a look at the chart of FXI. Still just trading around the 50-day VWAP here. And who knows, maybe after the election, then they pull out the big guns, the mother of all fiscal packages. And so any further dips in China, I will be buying. Just moving over to oil, which traded really heavy last week. The world's sitting at record production, still got demand worries from China. What's happening in the Middle East doesn't seem to spook the market at all. Oil nor stocks. And there's a look at crude oil futures, just sitting below $70 a barrel. Gold also found another new all-time high here today, and what was really on fire going into the weekend, silver, breaking out to a 10-year high, and this is another commodity of the future. More and more companies starting to discover how it can be used in AI and electronics. I think that's going to help it stay in a bull market for many more years, just like others. Uranium, copper, nickel, lithium, these are all the metals and minerals of the future, the electrification of this world. But it's not just the increased demand from the fourth industrial revolution that's going to help propel commodities higher. Fact is, the US balance sheet has never been in a worse position. Debt skyrocketed, interest payments have skyrocketed, while the average rate they're paying on that is still less than 4%. The US cannot simply afford high interest rates. They have to be kept low. And that's why I think there's going to be a structural tailwind for inflation and commodities. And just another reason why I hold zero bonds, haven't for years, and I also hold very little cash. I'm always looking to keep my money invested and protect my wealth and purchasing power from inflation. And like I said, ever since Jay Powell cut 50 basis points, it's like he rang a bell at the top of the bond market this year. We're seeing that again today, the 10-year ripping up to 420. This is the market pricing in. The US economy is going to hold up, GDP potentially expanding, along with inflation holding up. And wouldn't it surprise a lot of people? If GDP, which is currently tracking around 3.4% this year, according to the Atlanta Fed, imagine the US economy grew at 4% next year, 4.5% going into 2026. Wouldn't that surprise a lot of people? That's why we've got TLT 30-year bonds still trading really heavy, continuing to march lower, even though high-yield bonds are still holding up really well, and the market's expectations of inflation continuing to track higher as well. Along with industrial stocks set to benefit from America's reshoring of production manufacturing, like this one today, Construction Partners under ticker ROAD. Coming out of Atlanta, they're involved in the construction of roads and highways. They too trading at all-time highs, ripping up here again today on heavy volume, and other engineering and construction companies as well having a good day today. Tutor Perini ripping up 12% on volume. You don't have to agree with my opinion or the politics out there, but like I said, money doesn't lie. Markets are usually right most of the time. Also got news today that Robinhood is rolling out high-risk margin trading in the UK after getting the regulator nod. Now, this is good news for Robinhood investors, not so good news for investors and traders over there, in my opinion, because plenty of data and research has shown that retail traders that trade on margin are net losers, just like retail day traders and retail CFD traders are net losers as well. A lot of research shows over 90% of retail day traders and CFD traders lose money, especially with CFDs as well, which I consider possibly the worst financial product ever created. For my American friends, you may not know what I'm talking about, and that's because CFDs are illegal in America, and for good reason. And that's because with contracts for difference, CFDs, you don't actually own the asset. You're trading against the broker. You're not even trading on a real exchange. So they're pretty much the online casinos of the trading world. In fact, you actually have better odds at a casino than with a CFD broker. You look at the bottom of a lot of CFD broker websites, and they have to, by law, say how many percentage of customers lose money. Quite often 80% or more. I've seen stats that approximately 74% of people who enter a casino leave with a loss. And in fact, if you stick to basic strategy with blackjack, you can get the house's edge down to around 2%. Plus, they'll give you free drinks. Your CFD broker, they won't even send you a Christmas card after you've pissed your whole account up against the wall. So make sure you're trading on a real exchange like a big boy. And remember, with day trading and CFDs, you've literally got better odds playing blackjack. But anyway, maybe I should do a deep dive video on this one day. But like I said, that's good for investors who are on the other side of those punters. And Robinhood shareholders, with the stock having a strong performance this year, making a comeback. And I think this platform has a lot of potential. Just going out to a monthly chart here, has been whacked down ever since IPO. I remember when they first shot up, meme traders jumped head over tail to get in. They did a massive secondary offering, shot the price back down. Looks like we've done a classic stage 1 accumulation, potentially right in the midst of a stage 2 advance. Really strong volume accumulation signals here. And especially now they're expanding in the UK. They offer margin trading, option trading. Retail traders been lured into day trading. All that stuff loses a lot of money, not only due to their trade losses, because trying to beat algos in modern day markets is practically impossible, but also they just churn their accounts by paying the bid-ask spread and commission. So I'd rather be a part owner of the broker that does that than one of the punters trying to beat their algos. And so people quite often get me confused with others. But just remember, I'm Jared from Click Capital. I've never promoted day trading to you. I never have, I never will. And I definitely would never promote a bucket shop to you, as I prefer to see my clients actually making money instead of chasing a fake pipe dream. And it kind of just blows my mind that we're sitting here in 2024 still talking about this. I remember when I worked in an investment bank all the way back in 2006, we even used to say back then, by the time you see it, it's already gone. Because algos were coming into the market in a big way in 2004, 2005, really dampened volatility, widely held narrative and consensus. In fact, just looking at the VIX index back then, I remember this time back here, algos came into the markets in a big way. The VIX was just motoring lower, getting down under 12, 11, even 10, and just staying down there. And there was a big consensus. Then volatility had been zapped out of the markets forever. The electrification of markets, algos, everything's too well priced, too efficient. But then as markets quite often do, they flip the narrative consensus on its head. We got the GFC and volatility shot up to almost 100. But my point is, whatever edge you think you have, whatever chart pattern for day trading, it's already been discovered by the big algos, and they've got practically unlimited resources to get in there, take that opportunity, jump in front of you. And that's why over 90%, I actually think it's 99% of retail day traders will never be successful and will always lose money in the end. As you guys know, I'm only an active investor and swing trader. And even when I swing trade, average holding time, 2, 3, 4 weeks. And even that is a thin margin game as a retail trader. Can't imagine trying to step in front of algos. Just ridiculous if you ask me. But just moving on to what I said earlier in this video, one of the best billionaire hedge fund managers owns, Stanley Druckenmiller, looking at his portfolio here. He's still heavily invested in tech, a diversified portfolio. Got some manufacturers, energy stocks, a few healthcare stocks, copper stocks. He's also got Palantir that I also hold as well. Also interesting to see, like myself, he's also increased his positions in Argentina. But one stock I thought I'd profile today, and even though it's a really small position in his portfolio, it's been doing well. Thought it was interesting for Stanley Druckenmiller to have a position in Terrible. And so basically they're a Bitcoin miner, but they also offer infrastructure for the AI boom as well. And there's a look at the stock today, popping up 18% on heavy volume, and this has been hugely volatile. Just looking at a monthly chart here, had that big rip up in 2021, it's been basing for over a year now, big volume, 2.3 billion market cap, and so crypto stocks have been coming back to life of late. It could be on the cusp of another massive break here. However, if we get a surprise on the 5th of November, any sort of funny business in the swing states, they can't decide the winner by midnight, all that stuff we got last time, going to see Bitcoin dive. Now, like I showed you, the market's only given that about a 38% chance of happening. However, I do suspect any dips before then in the next 2 weeks could get bought up, and if the outcome is as expected, we could be breaking out to brand new all-time highs. And once again, Fed Fund futures still giving slight probability the Fed may remain on hold when they meet 2 days after the election. It's going to be really interesting to hear Jay Powell's language after that. Might start talking about inflation again. But either way, for the here and now, looks like the AI bull continues, and we may have just got confirmation of that today with Nvidia breaking out and closing at brand new all-time highs. They still don't report earnings for 24 days, and we've still got to make our way through a bunch of other earnings before then. Tesla Wednesday, the next week Apple, Microsoft, Amazon, Alphabet, and Meta. Next week's the big one for mega cap tech, and the Nasdaq Qs starting to shape up just below all-time highs as well. And once again, the market appears to be doing another good job at playing gotcha. Consensus coming into October as we're supposed to dive, correct? That's what seasonality was telling us. However, the market's already goosed up on liquidity, and now they're pricing in a more pro-business admin, along with Nvidia breaking out. All these amazing new technologies, that's why I'm convinced we're in the roaring 20s, and it's still early days in the fourth industrial revolution. And I, for one, plan to participate and profit from it, and I hope you do too. Thanks very much for sticking with Click Capital, and I hope to see you again this time tomorrow. Cheers.